Welcome to another IFRS session with Arrow Academy, where we simplify complex accounting standards for you. In today's session, we'll explore IAS 36 Impairment of Assets, covering both the key principles and practical applications of the standard. Understanding this is crucial for ensuring accurate financial reporting and avoiding overvaluing assets. IAS 36 establishes guidelines to ensure that assets are not carried at amounts exceeding their recoverable value. This standard plays a vital role in maintaining the accuracy and integrity of financial statements by preventing the overstatement of asset values. The core principle of IAS 36 is simple. If the carrying amount of an asset exceeds its recoverable amount, an impairment loss must be recognized. The recoverable amount is the higher of fair value, less cost to sell, and value in use. IAS 36 applies to most non-financial assets, but there are exceptions such as inventories under IAS 2, deferred tax assets under IAS 12, investment property under IAS 40, and financial assets under IFRS 9. Understanding these exclusions is key to applying the standard correctly. Impairment occurs when an asset's carrying amount exceeds its recoverable amount. This can result from changes in market conditions, physical damage, or a decline in the asset's utility. For example, technological advancements can make an asset redundant. Recognizing impairment ensures that assets are not overstated on the balance sheet. The recoverable amount of an asset is the higher of its fair value, less costs of disposal, and its value in use. Fair value is the price obtainable in an orderly transaction, while value in use reflects the present value of future cash flows generated by the asset. Now that we understand the key principles of IAS 36, let's dive into its practical application. Applying IAS 36 requires careful judgment and attention to detail. The standard's requirements can be complex, but following a step-by-step process can ensure compliance and accuracy in financial reporting. One of the first steps in applying IAS 36 is identifying cash-generating units, or CGUs. A CGU is the smallest identifiable group of assets that generates cash inflows largely independent of other assets. Accurate identification of CGUs is critical for performing impairment tests. Identifying CGUs can be challenging, particularly when assets are interdependent. Common issues include defining CGU boundaries too broadly or too narrowly, leading to inaccurate impairment testing. It's important to identify CGUs consistently unless a change is justified, in which case the change must be disclosed. Entities must assess, at the end of each reporting period, whether any indicators suggest that an asset or CGU may be impaired. Indicators include significant drops in market value, adverse changes in the environment, or reduced asset utilization. When calculating value in use, careful attention must be paid to the assumptions in the cash flow projections. Overly optimistic or unrealistic assumptions can result in incorrect impairment conclusions. In this section, we discuss how to estimate future cash flows and consider possible variations in amount and timing. Selecting the appropriate discount rate is crucial in calculating value in use. The discount rate should reflect the specific risks of the asset or CGU, including factors like geographic location, market conditions, and currency risks. In this session, we've covered both the key principles and practical application of IAS 36. You now understand the importance of recognizing impairment, identifying CGUs, assessing impairment indicators, and calculating recoverable amounts. Stay tuned for more insights from Arrow Academy, where we continue to simplify complex accounting standards for you. Thanks for joining us in this session on IAS 36. Don't forget to like and subscribe to our YouTube channel for more content on IFRS and financial reporting. Follow Arrow Academy on social media to stay updated on new events and learning opportunities.